All right, let's talk candlestick trading. Now, we could just throw a bunch of patterns at you, but that's not the point. Today, we're going to dig into the one single idea that makes this whole thing work, the why behind the patterns. Let's jump in. So, right off the bat, let's ask the big question. Can the past really predict the future of the market? I mean, can looking at what happened yesterday or last month or even last year, can that actually give you an edge on what's going to happen tomorrow? It sounds a little like reading tea leaves, doesn't it? But believe it or not, this is the absolute foundation of all technical analysis. And that question leads us straight to the single most important assumption you have to make, the big one. At its core, all of technical analysis, all those charts and candlestick patterns, they're all built on one simple idea. History tends to repeat itself. Seriously, that's it. That's the bedrock for everything we're going to talk about today. Okay, so what does that actually mean? It's not some vague, fuzzy feeling, right? It's a very specific idea. The assumption is that when a certain set of factors, a certain recipe of market conditions that happened in the past, shows up again, we expect the same outcome to play out. Let me show you exactly what I mean with a real-world example. Okay, picture this. A stock, it's been falling for 4 days in a row. Not great. Then, on day 5, it falls again. But wait, something's different this time. The volume, the number of shares being traded, is way down. And the price didn't move as much. It had a much smaller range. Then boom, the outcome on day 6, the stock totally reverses and rallies. You've just witnessed a specific set of events lead to a very specific result. All right, now let's hit the fast forward button. A few months go by, and you see the exact same setup unfolding. 4 down days, then a 5th down day, but with that same low volume and tiny range. So, based on that big assumption we talked about, what do you think is going to happen on day 6? You'd be expecting another rally, right? Of course. But there's a really important catch here.
And here it is. This is the fine print. History repeats itself, provided the factors are the same. That's the magic phrase. It's not enough for things to be kinda similar or in the same ballpark. Precision is everything. The closer the current situation matches the one from the past, the higher the odds that you'll get the same result.
So, if the whole game is about spotting these repeating histories, how in the world do you actually find them? Well, that brings us to the actual tools of the trade. Let's talk about how traders identify these moments. Candlestick patterns. You know, probably the best way to think about candlestick patterns is to see them as the actual language of the market. Seriously, every single candle and every sequence of candles is telling you a story. It's the story of the constant tug of war between buyers and sellers, between supply and demand. When you learn to read these patterns, you're basically becoming fluent in market speak. And just like any language, this one has its own grammar. You can break it down into 2 main types of patterns. On one hand, you have single patterns. Think of these as powerful single words. Just one candlestick can be enough to give you a really strong trading signal. And on the other hand, you got multiple patterns. These are more like phrases or sentences, where you need a few candles in a row to tell the full story. So, here are some of the classic single candle patterns. Now, don't get hung up on the names right now. Maribozu, Doji, spinning tops. We'll get to those later. For now, just focus on the idea that the shape of just one day's candle can tell you a whole lot. For example, imagine a super long green candle with no wicks at all. What's that telling you? It's screaming that the buyers were in total control, from the opening bell to the close. See? One candle, one powerful word. Then, of course, you've got the multiple candlestick patterns, things like the engulfing pattern or the morning star. If those single patterns are the words, these are your full-blown phrases and sentences. They tell a more complex story that unfolds over 2, 3, or even more days. They're great at showing you when the market mood is shifting. Again, don't worry about memorizing them. Just think of this as the advanced vocabulary you'll eventually learn to spot. Okay, so we've got the big idea down. History repeats itself, and we know the tools we're using, these candlestick patterns. But how do you actually put it all together? How do you use this stuff? This brings us to the most practical part of our chat today, the 3 golden rules for candlestick trading.
Yep, just 3. Think of these as your rules of engagement, your guardrails. Following these is what separates just randomly pointing at shapes on a chart from having a real, disciplined strategy.
Rule number 1 is super simple but absolutely critical. Buy strength and sell weakness. What does that mean? Well, when you see a big, strong, bullish candle, it means buyers are in charge right now. When you see a big bearish candle, sellers are winning. This rule is all about trading with the immediate momentum. Don't try to fight the tide. You want to swim with the current.
All right, rule number 2. You have to be flexible. Look, the market almost never gives you a perfect textbook definition pattern. It's just not that clean in the real world. You're going to see small variations. So the key is to understand the psychology behind the pattern, the spirit of it, not just memorizing the exact shape. You have to figure out what's close enough while still making sure the underlying story is the same. It's a balance. You're precise, but you're not rigid.
And last but not least, rule number 3. And honestly, this might be the most important one of all. You have to look for a prior trend. This is all about context, context, context. A beautiful, powerful bullish reversal pattern is completely useless if it just pops up in the middle of a choppy sideways market. For it to mean anything, it has to show up after a clear downtrend. That's what makes it a reversal pattern. Without the right context, the pattern isn't a signal, it's just random noise.
Okay, so let's tie this all together. What are the big takeaways? First, the whole system is built on one belief. History repeats as long as the conditions are the same. Second, we use single and multiple candlestick patterns to spot those repetitions. And third, we use our 3 golden rules to trade them. Buy strength and sell weakness, stay flexible, and always look for a prior trend.
And that leaves us with one final question to chew on. We've talked about data-driven patterns, which sounds very scientific. But we also talked about the need for flexibility, for interpretation, which sounds a lot more like an art. So what do you think? When you put it all together, is trading with candlesticks more of a science or is it more of an art? Something for you to think about. Thanks for tuning in.